Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. How you doing today? Hope you're having a great day so far. Well, hey, I've got a little bit of, I need some help from you here a little bit. I did a video last week about some comments that Dave Ramsey said about investing in the mutual funds that he suggests for the life, well, for your life, really. And while there's nothing wrong with that, if you want to be aggressive, I was saying, you know, occasionally people can't handle that. They just can't handle that kind of volatility. And we tried to illustrate how that could affect your overall bottom line as well. And thank you for being kind with your disagreements, by the way. That's okay. Anyways, here's my case in point. Got a guy, we'll call him Steve. Yeah, probably won't mess that up. Let's call him Steve. And Steve's been coming by every now and then. He come by the studio. He's not a customer yet. And here's what's happened. I want to go through his scenario with you and kind of illustrate how maybe this applies to you and you see what you think. And I'm really interested to know what you think, by the way. I know I probably opened up a can of worms there, but let's dive in here and just see what we can do. Let me tell you about Steve real quick. He's 55 years old, right? So we're going to go with that first. Young guy, but he's been forced to retire, right? Had an injury at work. He's been forced to retire. He's on disability. And so he has a total of, we're going to just round a little bit up here, and we're going to say 1 million. I mean, round up a very, very little bit. He's got essentially $1 million in investments, and you go, oh, well, that's rather impressive. But he's 55. He's got to make this last the rest of his life. And herein lies part of his stress. One of the first things that he will tell you, this Steve, when you meet him is, the markets really stress me out, man. I worry about when my account drops $100,000. It scares me, right? I know everything's going to be fine, but he'll come right out and say, that's my number one concern, man. That really bugs me. I'm 55 years old. I can't go back to work. I can't do something to make more money. And so I'm a little bit nervous. And that's the first thing he says. So as a financial advisor, which we are here at Jazz Wealth, there is no way I'm going to tell the guy, you know, it's okay if you want to be aggressive. If it were me, I was him, I'd have no problem being aggressive. But he's already telling me he can't do this. And so my question to him is, well, what does your current advisor say? What are they doing to help you understand that? And I think maybe a little bit lacking there because, like I said, it was family that was managing his account, and I totally understand that. Family sort of always assumes you know more than you are and you're more comfortable and all that. But anyways, let's move on. Let's keep going here. So Steve has no debt, by the way. That's very good. He's got a good thing going for him there. He's good with his money. He does like to travel a little bit from what I can tell. But that's basically where he's at. He's got disability now. The disability comes in at $23.50 a month there. Sorry about that. But he doesn't want to use that. He's like, I don't want to count on that for income. I don't know why. He just doesn't want to count that. So one of the things that I do initially is just go, what do you need, right? As investors, we invest for what we need first. We invest for what we want second. And we invest for what we can handle third, right? Because your wants will allow you to take a little volatility. So I always tell people, let's invest for what you need. Let's make sure you get to where you need to go. And then let's talk about some of the things you may want. And then we'll see if we can add some volatility in there. You'll probably be willing to handle a little more volatility if I can squeeze in some of your wants, right? So here's where Steve's at. He's got the $1 million. He's got $23.50 coming in. He would need $40,000 a year to live, not counting his disability. He needs the $40,000. He wants to push the limits and go for $50,000, right? Now, currently, he's got a rental property, makes $0 on it. He can't sell it, right? He's got 2 notes on this rental property. So we've got note number 1, we'll just say over here, and note number 2. This one's about $75,000, interest only, coming due, I believe, next year, right? So he's got some decisions to make here. He owns his house outright, so his home, his primary residence is all taken care of, nothing to worry about there. But again, you look at this picture and you go, well, that seems pretty straightforward. I have a couple ideas how he can get to $40,000, maybe $50,000, and sort of knock this thing out. But Steve is concerned about volatility, okay? Number one concern is volatility. He did not like the October, November, December decline in the stock market, so much so that he started going to classes to actually start learning about the markets because nobody seems to be teaching him, you know, how things really work around here. So he started going to classes to start to learn. Now, how are we going to invest for Steve? And this is where I want your help. I'm going to present a scenario for Steve, right? And essentially what I'm doing is making this video just for him to try to sell him on the idea of moving his accounts over to Jazz Wealth. If you guys support the sort of portfolio that I get ready to build for him, let me know, right? If you find an improvement on that and there's a way to do a little bit better than what I sort of present, that's awesome, right? Let's help Steve out here. So this is what I would do, and I've mentioned this to him a couple times, but never really got into great detail. So today I'm going to go ahead and do that. All right, here's what I'm going to do. First thing, I'm going to go onto my website and the public funds that are there, and I'm going to see what choices we have to help Steve out. I can't invest Steve aggressive, right? I have to try to avoid that. He can't handle it. He doesn't want to deal with it. I know over time, when I take Steve through some severe down moves in the market and some strong up moves, I know I can build his confidence through teaching him how this is all really going to work. But for right now, I cannot have somebody stressed about their account volatility, right? So here's what we're going to do. We're going to skip the funds at the top. It says aggressive. You go to our website, you click portfolios, you got aggressive in there. We don't need that this time. Not only do we not need that, he can't handle it, right? And that's okay. I'm not picking on Steve. He knows I'm not picking on him. But we need to give him a clear head to start here. So first thing I'm going to do is I'm going to look at my dividend fund. So the dividend fund I'm actually really proud of, but this one's going to be the most volatile out of all of them, right? It's currently yielding 3.5%, right? And that was over 4%. Average this year, average for the last 12 months has been just over 4%. But here's the thing. I'm going to lay this out in such a way where we can go through and kind of help you understand how the portfolio moves. So currently the dividend fund has a yield of 3.5%. It moves at about 80% the speed of the market, right? Just a simple way to say it. I know some of you can take it a little bit further. You can sort of dive in and figure out what's going on there. But it's just easy to tell Steve, you got this fund here. It's going to pretty much move the same pace as the market. So we don't want to go all in on this fund. As enticing as that 3.5% sort of seems, we don't want to go in. Now the volatility is going to be at about 3/4 of the overall market. What does that mean? That means the day-to-day fluctuation is going to be about 3/4 the movement of the market. Okay, so far it sounds like I'm not really solving Steve's problem. He does not like volatility. He does not like things moving around a lot, but we got to get a little bit of this in there. And remember, there's no commissions or anything here. We can spread him out as much as we want until we finally tune this portfolio that he's looking for. Next thing I'm going to do is I'm going to look at our consumer staples fund. I've done classes for our customers to kind of show the consumer staples sector of the market and how it performs through good times and bad, so that I'm taking my opinion out of it and I'm able to put fact behind it. And consumer staples by far is something that we got to have for Steve here. Currently yielding 2.7%, average is over 3% on that one. It's just currently where it's at because everything's sitting at super duper highs if you look at the consumer staples sector right now. Now here's the kicker. This thing moves at about 50% of the market. It's just a little bit less than 50% of what the market does. Now we're getting somewhere, right? Steve, you're watching, right? Now you start to see, okay, I've got something here that's going to be nice and slow. Not super slow, right? It's not too hot, not too cold. It's just, it's sort of slow. All right, also, it's going to move at about 3/4 of the volatility. So we're going to see a little bit of fluctuation there still. We haven't solved Steve's problem yet. We're moving a little bit slower, but we haven't solved the problem of that volatility. To solve that problem, I'm going to go all the way to the bottom of our list and look at the low volatility fund. This is one of my favorite funds. I know I say that about the dividend fund, but this is actually one of my favorite because this is slow and steady. Almost nothing happens there. It's actually doing really well this year. I just love the idea of how slow can you get something to move with the biggest possible return. So we got a 2.28% yield on that right now. I think that's right where that one's at. And it moves at about 30% of the market. Awesome. Steve doesn't like that. He doesn't want to see, rocket ships. He doesn't need to make 20% in a year. He just needs to make sure he's going to have enough money the rest of his life. So already you're kind of seeing, while he could make a lot more money in the long run, right? He doesn't need to. And that's where I think a lot of the younger investors get that disconnected. They think they need to have this huge return, and that is certainly, could be the case, but what is it that you're investing for? Always remember that. Here's a guy that just needs to get to the end of his life and feel good about himself, right? Have a great life, get to travel and do all the things he wants. Okay, so low volatility, 2.28%, 30% speed of the market, and its volatility is about 1/3 of the market. So really, really compressed day-to-day movements. Steve will not wake up and see that this is up 10% or down 10% or some news event causing it to crater. It's just not going to happen because it doesn't move that fast. I'm also going to squeeze in Reits in there. Now the Reits will start slow, right? But Steve's got to have Reits in there because that's currently yielding 4.1%, right? You got to get a little bit of that, right? And because there's no commissions, there's no issue or anything, we can do that. And currently, this is, I'll be honest with you, this is a little bit slow. It normally is not 44% of the market. If you look at Reits lately, they've just been on a steady sort of chilling uptrend, nothing really going on there. It will be about 50% of the speed of the market is this 12-month average there. So I don't want to mislead you there. But the volatility is about 3/4, right? Now, one last fund that I'm going to include, it's actually not on our website. It's called a Municipal Bond mix that we're just kind of playing with right now. It's got to be approved, and the regulators have to, all this stuff. But it's yielding 2% with no volatility, right? The Municipal Bond Fund spread out nicely, very tight. So very, very, very little volatility, I should say. All right, so here's what we're doing. I wrote a bunch of numbers on the board there. We're essentially building a portfolio that says, Steve, you're going to have to handle some volatility. Now, I'm going to coach you through it. I'm going to let you know how things are moving when they do. But here's the kicker. We are not going to reinvest your dividends. If I mix those funds together, we've got an average portfolio yield. I'm going to erase it if you don't mind. We got an average portfolio yield, including our municipal bond fund, of 3.13% currently. That's where it's at. Now, if you could do some quick math and go, well, hey, it's $1 million. That gets him over $30,000 a year in yield, right? So if we don't reinvest those dividends, now month to month or when they come in, I can start to show Steve, hey, look, you see the money coming in? You can pull from that. That's yours. We didn't pull from your principal yet, right? Now, if we get 3.13%, we only needed to get him to 4% total return for him to have what he needs, right? He wanted 5%, right? If we can get to 5%, now he'll have 5% of $1 million is $50,000. I'm oversimplifying the devil out of this, by the way. I'm not trying to make it seem like it's this simple. But now we know what we have to make up. We've got a current portfolio yield of this, which, by the way, it was over 4% when the market started falling just a little bit there. So we've got an average yield closer to 3.5%. We really need growth of 1 to 2%, somewhere in there, net, right? At the end of the day, net, to get him what he wants. Now, is that a lot to ask? 1 to 2% growth out of a portfolio. I would argue that we could probably even squeeze things down a little bit more because these funds that we're getting in here, even if we are highly diversified, they average much more than that, right? So what's the key takeaway for you and for Steve and everybody here is, first, what do you need? Then what do you want and what can you handle from there? Steve started with, this is what I can handle. I can't handle much, man. I cannot handle it. Currently, Steve's portfolio is in so many random things, he has no idea if he's going to hit his needs. He's just taking money out when he needs it. He's got no idea, right? So right there, I'm able to lay it out and go, Steve, I can get you close to the goal. Along the way, we're going to have some growth and there'll be changes. I'll get you higher yield if I can get it. I'll make that change in a second. But right now, I can get you close to your needs with what you can handle. Now, if you're telling me you can handle a little bit more, I can get you to those needs on average, right? It's going to hurt a little bit more. Some of us, it wouldn't bother us, but for Steve, it's going to bother him, right? That's the key. That's what we want to work out. And so it doesn't matter whether you're Steve and you have $1 million or you're Joe and you have $1,000 and you're starting with Jazz Wealth. Either way, I'm going to ask every one of you when you get started, what do you need? Tell me. I'm going to have questions for you. When do you want to retire, right? What can you handle? Do you mind if you see volatility in your account? I want to know these things because then it lets me go through and say, okay, well, I know how I'm invested. I'm invested in what we call the aggressive mix here at Jazz Wealth. I like to swing for the fences. I'm comfortable with it. I'm younger. I've got time and everything. I get it. But what I want you guys to do is say, okay, that's what Steve needs. Now I understand, right? This is what he can handle. That mix of portfolios that I put out there, some of you are going to laugh at that. And some of you are going to say, that's ridiculous, Dustin. Why would you do that to this guy? Because that's what he can handle, and it gets him to what he needs, right? Some years we're going to get him more than he wants, right? But it gets him what he needs. And I can explain that to him clearly now and say, see how we're going to get you what you need? And he can go travel and do his thing and have a great time, right? Think of the stress we just took off of him. Now, when the markets have a bad day, I'll bet you anything, Steve's going to call up and say, oh, how'd we do? Did your plan, did what you explained to me, did it pan out the way you said it would? And I can go, Steve, it did. Or Steve, we made a few adjustments, whatever it may be. Happy to help. All right, anyways, I need you guys to let me know in the comments below if you agree with approaching someone's investments from the standpoint of what they can handle so they can sleep at night, or do you think we should just say, no, you're leaving money on the table, Steve. Invest aggressively, go live your life, you'll be just fine. There's going to be some very scary moments, but you'll be fine. I need your help. I told Steve that we would look in the comments here and we would see what people thought. So are you cheering him on with this, or are you disagreeing with it? Either way, it doesn't matter to me. Just keep it positive. You know what I mean? I'm not trying to harm anybody here, so your comments shouldn't be harmful. Anyways, hey, later on today, we're going to do a stock market update show. Every day at 5 o'clock, I do an update. It's mainly for our customers, but I like to share it with the public as well so that you know what happened in the stock market today. I hope you'll join us for that. We will see you a little bit later. And again, let me know what you think. Don't worry about the subscribe button or the like button or anything. Just let me know what you think. Help us out in the comments below. I appreciate it. We'll see you later.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.